Hello everyone. We're going to take a look here at Chapter 6. In Chapter 6, we are looking at the operating cycle as it relates to retail companies as well as manufacturing companies, but specifically we're going to concentrate on retail and distribution companies. Well, the operating cycle includes basically selling a product for a profit. That's the whole idea. So as you see on this diagram, we start with cash, and then the cash, what we do with it is we go out and we purchase merchandise. Merchandise, another word for merchandise, which is more common in accounting world, is inventory. We buy that inventory, we put it on our shelves, and we sell it to our customers. If our customers don't pay for the merchandise right away, we would enter into an asset called an accounts receivable, as we've talked about in prior chapters. The accounts receivable ultimately would be collected and we convert it back to cash. The whole idea, obviously, is to sell the merchandise for a lot more than what we purchased it at. And we just do it again and again and again and again and again. That is the operating cycle of a merchandising company. And that's what we're going to study in this particular chapter. Okay, let's really not talk too much about manufacturers, so I'll flip over those slides. Retailers. Now, a retailer is in a business of selling merchandise directly to the public. You can see some examples here. You're all familiar with it. Lowe's, The Gap, Walmart, Publix, Best Buy, places like that. They can also be pretty small businesses like a gas station or a convenience store. They're basically selling a product directly to the end user. That's what a retailer does. Wholesalers also sell merchandise, but they're not the ones that sell it directly to the end user. Wholesalers actually sell their merchandise to the retailers, and then the retailers sell them to the end user, like you and I. Okay, now, in prior chapters, we talked about the income statement as one of the financial statements. On the left-hand side, this is pretty much what we've talked about in the prior chapters, where we've looked at our income statement simply looking like this. Revenues minus expenses equals net income. Well, in this chapter, I'm going to expand that a little bit more. And what we're going to do is we're going to break up our expenses into different categories. So if you see here with my cursor, I'm kind of circling the expenses on the service company's income statement. On a merchandising company's income statement, we're going to break this expenses up into two categories. First, the cost of goods sold, and then the other expenses are way down here, the other expenses. Now, what is this cost of goods sold? Why is it so important that it needs to be separately stated? Well, what the cost of goods sold is, basically it's the expense of the inventory that we sold. So once we sell the inventory, whatever our cost was for buying that inventory and holding that inventory, we will record it as an expense, and that expense is called cost of goods sold. Because of that, we have this new subtotal called gross profit. So revenue in a merchandising company's business is typically called sales. So the term revenue for a service company and sales for a merchandising company, they're pretty interchangeable, synonymous terms, if you will. So your sales less your cost of goods sold is going to give you a subtotal, and that subtotal is called gross profit. Sometimes you'll also see the term gross margin. It means the same thing. And then from the gross profit or the gross margin, we subtract out all of our other expenses. They're typically called the selling and administrative expenses, and that'll get us to finally net income. All right, so I just wanted to show you what the income statement looks like. Here is a company that we're going to work with in this particular presentation, Computer City. This is what their income statement looks like for the year ended December 31, 2018. We started off with sales of $900,000, less your inventory expense, the formal name, cost of goods sold, $540,000 is going to equal the subtotal. We'll call that gross profit or gross margin. And then we'll subtract out all of our Other operating expenses, and you can see a listing here: wages, advertising, insurance, utilities, office supplies, and depreciation. You add up all those expenses, they total $234,000. Subtract that from gross profit of $360,000. You get your income before taxes, and we'll segregate our income tax expenses so we all can see it, $36,000, and the result is net income. So at the end of the day, the merchandising income statement really follows the same formula, which is revenues minus expenses equals net income. The only difference is with the merchandising income statement, we break it up into different sections so it looks a little larger than it really is. As I said earlier, the cost of goods sold represents the cost to acquire the inventory sold. So it's really our cost of the inventory. Okay. We're going to use, in this case, when we have a merchandising company, we're going to use a main control account as well as what we're going to call subsidiary ledgers. So as an example, as we talked about in the prior chapters, we talked about recording the journal entries in the general journal and then posting those journal entries to the individual ledgers. Well, if we have an accounts receivable account that was recorded as a debit or credit in a journal entry, we're going to update the accounts receivable general ledger, which you see here in the top right of your PowerPoint slide. However, it gets a little confusing and it can get out of hand really fast. So what we're going to do is the accounts receivable, the amount of the accounts receivable, these could be amounts owed from multiple different customers. And we really want to be able to keep track of all of the customer outstanding receivables. So what we're going to do is, and you can see the red arrows here, the accounts receivable balance as of June 15th, 2018 is $7,000. Well, what we're going to do is we're going to open up some subsidiary ledgers for each individual customer. And you can see at this very simplistic point in time that the $7,000 is due from two customers, Sparks Inc. and Heather Jacobs Company. And you can see the two balances in those two customers equals the control balance. So sometimes with accounts receivable, and as we will see in future chapters dealing with accounts payable as an example, it makes sense to open up and keep track of subsidiary ledgers underneath the control ledger to break up the detail. That's what a subsidiary ledger does. Okay, now inventory. Inventory is an asset. When we buy the inventory from our vendors and we put it on the shelves and we have it ready for sale to our customers, that is an asset that we would record. And then as we sell that inventory, you can see the bluish green arrows here on the right side of the PowerPoint slide, that inventory becomes reduced off of the balance sheet with a credit, and we're going to put it on the income statement as a debit to the cost of goods sold account. Okay, there are two ways that we can account for a merchandising company's inventory. The first way is called the Perpetual Inventory System, and the second way is called the Periodic Inventory System. I have to say, in today's technological day and age, most companies use the Perpetual System. Let me explain the Perpetual Inventory System first. With the Perpetual Inventory System, just like the word would entail, perpetual, what this means is every time there is physical movement of inventory, we're either receiving inventory from our vendors or we're selling it to our customers, or maybe there's some returns between the vendors and us or the customers and us, regardless of the movement of inventory. Every time there is physical movement of inventory, we are going to update that inventory account on the balance sheet. And when we sell the inventory, we're going to record not only the sale, but we're also going to record the release of the inventory to the cost of goods sold account. Okay, let's go through some examples here. The first journal entry is us as the retailer. We are going to purchase inventory from our vendors. So in this case, we purchased 10 Regent 21-inch computer monitors on account from our vendor, Okawa Wholesale Company. The monitors cost $600 each. We bought 10 of them, so 600 times 10 was $6,000, and it says here payment is due in 30 days. So upon purchase of these inventory items, you can see down here, here's the journal entry on September 1st. We're going to increase our inventory account with a debit, and as assets do get increased with debits, as you're aware of at this point, and we're going to increase our accounts payable account. Accounts payable is a liability, and they are going to be increased with a credit. That was on September 1st, all right? September 1st. So now we go to September 7th. Computer City sold 2 computer monitors for $1,000 per unit on account to our customer, RJ Travel Agency. So we sold it on account. Remember what this means. That means we did not yet receive payment from our customer. But we made the sale. We physically gave them the inventory. The sale needs to be recorded. So on September 7th, there's a little typo here. It says September 10th in the date column. Let's make that September 7th. What we're going to record is 2 journal entries upon the sale. We sold it for $1,000 each, and we sold 2 of them. 1,000 times 2. The sale is for $2,000. And if you see the journal entry, what did we do? We increased the accounts receivable account, which is an asset. We increased it with a debit, and we recorded the sale. Remember, this is the revenue. In addition to recording the sale, we also need to record the release of the inventory. The inventory is no longer ours. We no longer have the asset. So this next journal entry, we're going to debit the cost of goods sold. And remember, this is just a fancy way of saying inventory expense. And then we're going to reduce the inventory, the balance sheet asset, with a credit. And look at the dollar amount. Do you see the dollar amounts are different? The sale amount is $2,000, but our cost, remember on the prior slide, we purchased these units from our vendor for $600 each. So when we reverse them out of the inventory account, they're going to come out, they came in at our cost, and they're going to be reduced out of the inventory account by our cost. 600 times 2 is $1,200. So what is the gross profit on this sale? I think you had enough time to figure it out. It's $800. Very good. Sales minus the cost of goods sold is your gross profit. Okay, October 1, Computer City paid the Okawa Wholesale Company. If you recall, back on September 1, we entered into a payable for $6,000, and here we are 30 days later. We are paying it. So we're going to reduce the liability with a debit, and we're writing a check, so we will reduce our cash account with a credit. All right, 6 days later, October 7th, Computer City collected the $2,000. You remember our customer bought computers from us way back on September 7th. Now they are making payment. So you can see in our general journal down on the bottom of the screen, we're going to increase our cash account with a debit, and we are going to reduce the receivable account with a credit. The receivable now has a running balance of 0 since it's been paid off by the customer. All right, and last but not least, at the end of the year, even though we're perpetually keeping track of the inventory balances, sometimes there is what we call inventory shrinkage occurs during the year. Maybe something broke in the warehouse, maybe something spoiled, maybe something was stolen. And you know what? Theft can be either on the employee side or the customer side. I know a lot of us think of theft on the customer side, but yeah, theft could occur on the employee side as well. That would be very bad, but it certainly could happen, especially if there are poor internal controls set up in the warehouse. In any event, we do a physical count. And we do a physical count, and then what we do is we compare that physical count to the perpetual inventory records. And in this example, as you see here in the yellow box on December 31st, after we counted our inventory, we noticed that there was an inventory shortage of $2,200. And we're going to make an adjusting journal entry to reduce that inventory balance by $2,200. It's gone. There's nothing we can do about it. It might have broke, it might have spoiled, it might have been stolen. Wherever the case is, we need to reduce the inventory amount by that amount. and we will debit the cost of goods sold, basically saying it's an expense of the inventory. All right, so one of the last steps in the perpetual system, like I said, we keep track of the inventory balances as the inventory is physically moved in and out of our business. But at the end of the year, we still stop and take a physical count, and we will adjust the inventory perpetual records to the physical count. Okay, that is what we do. Now, the closing entries, just like we learned in a prior chapter, we're going to close out the revenue account, called the sales revenue account, to income summary. We're going to close out all of our expenses, which includes cost of goods sold now, to income summary. And then ultimately we close out the income summary account to retained earnings, and then dividends to retained earnings. If you recall from a prior chapter, this is exactly what we did. And the author says here, we simply mirrored the closing entries for a service type business. No change. It's just that we have this fancy account called cost of goods sold, which is an expense account. All right. So that is the first method of accounting for inventory. The second method is called the periodic inventory system. The periodic inventory system is less sophisticated. This used to be more prevalent in the past when there wasn't a lot of sophisticated technology to keep track of the physical movement of inventory. But now that technology is caught up with the physical movement of inventory, it goes as fast as the physical movement of inventory. That's why perpetual inventory systems are used more often. But basically what we do with a periodic inventory system, as the name would entail, periodic, that means we only update that asset account inventory at the end of the year when we count it, when we physically count the inventory. Let me take you through the journal entries. Okay, here we go. January 6th, Wagner Office Products purchased merchandising amounting to $2,000 on account from Inkjet Solutions. So we are Wagner Office Products in this example, and we bought merchandise from them, $2,000 on account. That means we didn't pay for it just yet. Instead of debiting inventory, which is what we would have done with the perpetual inventory system, what we're going to debit is this account called purchases. Purchases is a temporary account. At the end of the period, it's not going to have a balance. It's just a place that we actually are going to record everything we purchased from our vendors. And I'll explain how this goes away at the end of the period in a few minutes. And we bought it on account, so we're going to increase our liability account called accounts payable. All right, now, how do we compute cost of goods sold? Because we don't keep track of inventory on the balance sheet and cost of goods sold on the income statement throughout the year, what we do is we have to actually figure out cost of goods sold using a mathematical computation. And the mathematical computation is down in the red box in the bottom part of your screen here. And this computation is as follows. We're going to take the inventory balance at the beginning of the year. All right, so if you visualize a warehouse, that is what we started the year with. $14,000 worth of inventory costs in that warehouse. Well, during the year, we purchased an additional $130,000 worth of inventory. You remember the journal entry I just showed you where we debited purchases and we credited the accounts payable? Well, we did that during the year totaling $130,000 worth. So the beginning inventory, which represents what we started the year with, plus the additional purchases during the year, $130,000, that is called cost of goods available for sale. Think about it. What we started with is the inventory, beginning inventory, plus what we added, the purchases. That's the total amount we possibly have to sell. Hopefully that makes logical sense to everybody. What you start with plus what you added is the maximum amount, the ceiling of what we could possibly sell. That's $144,000. So now the question is, Did we sell all of it? Well, let's go to the warehouse at the end of the year and count the ending inventory. In this example, we counted $12,000 of ending inventory at the end of the year. So if we had $144,000 of inventory available to sell, but $12,000 is still here at the end of the year, what happened to the difference? It was sold. And that is called cost of goods sold. $132,000. So what are the journal entries that we're going to make at the end of the year to record all of this? There are two journal entries. The first thing we need to do is we need to get rid of the beginning inventory balance. Inventory is an asset with a debit balance, so I'll get rid of it with a credit. And I'm kind of circling it with my cursor here. Purchases, as I explained to you, we're going to keep track of the purchases throughout the year with a debit balance. And at the end of the year, we're going to get rid of it. And that's what this credit is here. All right, so these are the credits, and the debit is going to be cost of goods sold. Now, that got rid of the beginning inventory. That also got rid of the purchases account. Now, the second journal entry is we need to actually record the ending inventory. If you go back to the prior slide, the ending inventory is $12,000. That needs to be recorded. We got rid of the beginning inventory of 14 in the first journal entry, and now we got to put on the ending inventory balance, which is 12,000. And the opposite side of the journal entry, cost of goods sold. What have these two journal entries done? The cost of goods sold was debited for 144. It was credited for 12. There's a net debit of $132,000 in the cost of goods sold account. Let me go back up to the prior slide. What's ending cost of goods sold? Well, there it is, $132,000. That is not a coincidence. That is on purpose. All right, and we've also recorded our ending inventory of $12,000. And this slide basically proves to you exactly what we've done. Is the beginning inventory was 14. We got rid of it with a credit. Purchases had a debit balance of 130. We got rid of it with a credit. So they both have zero balances at the end of the year. And now all of a sudden we've got this 144 in the cost of goods sold. All right. The ending inventory was 12,000. So we're going to establish that with 12,000. And the cost of goods sold, which did have a $144,000 debit balance, we're going to credit it for 12. So the running balance is 132. This all matches up with what we want to happen. So there's a few extra closing entries with the periodic system. We close our sale revenue accounts and our expense accounts to income summary, and then we close income summary to retain earnings, and then we close out our dividends accounts. There's a couple of other journal entries in there to establish the cost of goods sold and get rid of the purchases and adjust the inventory balances, as I showed you on the prior slides. Few extra steps. The reason why we do this is so the inventory does not need to be kept track of during the year. This is not used for many companies anymore. It used to be very prevalent. Nowadays it's only used for smaller companies that really don't have a sophisticated technology to keep track of the ins and the outs of the inventory, typically for small business. Okay. Now, sometimes when we actually come to an agreement with a vendor and we need to pay them, it comes with credit terms. Let me show you this, what you see on this slide here. Do you see where it says 2/10, N/30? It's read as follows: 210 net 30. And what that means is as follows. This means that if we pay within 10 days, we can take a 2% discount. If not, we need to pay the full amount in 30 days. So some companies will be able to take advantage of a discount period. There are two ways to record if our vendor is giving us a discount on the inventory we are purchasing from them. Here's an example. On November 3rd, Computer City purchases 100 spreadsheet programs for $100 each. So if we take the 100 programs times 100 each, that works out to $10,000. But our vendor, PC Products, they gave us credit terms of 210 and 30. So the first way we could report this is we could assume that we're going to take advantage of the discount and we're going to record the purchase. If you see the title of the slide, we're going to record the purchase at the net cost. So inventory is not going to be for the full $10,000. It's going to be $10,000 times 98%. We're assuming we're going to take advantage of the 2% discount. So debit inventory, credit accounts payable for the $9,800. Now 7 days later, on November 10th, we made payment. Since we paid, we entered into it in November 3rd, and we're making payment on November 10th. That's within the 10-day discount period. And so all we need to do is pay the payable. We will reduce the accounts payable with a debit, and we wrote a check, so we will credit the cash account. All is well. Now, let's assume we did not make the payment on November the 10th. Let's assume we waited until day 30, December 3rd, and we paid the vendor. Now, do we owe them $9,800? The answer is no. Since we passed the 10-day discount period, we owe our vendor the entire $10,000. That's why you see this journal entry below. We're going to reduce cash with the entire $10,000, credit of cash of $10,000. All right, that's how much we're writing a check for. Now remember, we only recorded the accounts payable at $9,800, so we'll reduce it by $9,800. The difference, the $200, that is an expense. We'll call it purchase discount lost or something along those lines. Just so you know that that is an expense. We don't want that to happen. The other way to do it, and this is my preferred way to do it, by the way, is to not record the original purchase at the net cost, but recording the purchase at the gross price. November 3rd, very similar. Computer City purchased $10,000 of merchandise. Terms are 210 and 30. What we're going to do when we record it at the gross price is we're going to assume that we pay the full $10,000. You see the journal entry on the bottom of the slide. We're going to increase the inventory balance sheet account with a debit, and we're going to increase our liability, the accounts payable account, with a credit for the full $10,000. Now, November 10th, we pay it within 7 days. We paid it within the discount period. So we're going to reduce the payable by the full $10,000 with a debit. But do we write a check for $10,000? No, we don't. We only write a check for $9,800, and that's why we credit cash for $9,800. The $200, that is actually a purchase discount taken. That will reduce cost of goods sold. All right, so it goes as a reduction. The inventory cost less than what we originally anticipated. That is the reason why we would reduce cost of goods sold with that $200 discount. All right, if we waited the full 30 days to make payment, and instead of paying on November 10th, we pay on December 3rd, pay the amount in full. Here's your journal entry. No harm, no foul, because we were expecting to do this anyway. We recorded the original payable back on November 3rd with the $10,000 credit. When we pay it, we're going to reduce the payable with $10,000, and we're going to credit the cash. Okay, we don't live in a perfect world. So sometimes we actually got to return merchandise to our vendor. So we bought the merchandise on November 3rd, and then November 9th, 6 days later, we said, hey, out of the $10,000 of inventory that we bought from you, $500, maybe it was the wrong color, wrong size, maybe it was broken, whatever the case may be, we need to return it. All right, well, if we have to return it, what we need to do is we need to reverse the original November 3rd entry. If we recorded the original entry at net cost, the $500 of merchandise that we're going to return, we're going to reverse it at 98%. Remember, we recorded it at 98%, so it's going to be reversed at 98%, which is $490. We no longer owe that payable, so we'll debit it to reduce it, and we no longer have that inventory, so we will reduce it with a credit. Okay, Transportation costs. All right, there are two types of transportation. If the transportation cost is to get the inventory from our vendor to our location, all right, transportation costs related to the acquisition of the inventory are actually part of the inventory cost. All right. Now, sales. Just like we can return inventory to our vendor, we can also have our customers, after they buy inventory from us, they can actually return it to us. So as you see, we have this sales revenue account. We also have contra sales accounts. There are two types of contra sales accounts: sales returns and allowances. This is when your customer returns inventory to you after the fact. I am sure we've all done something like this in our lives, where we bought something from a retail store and we had to return it later on. That's the journal entry account. This is the account that they would use. They wouldn't reverse it out of the original sales account. They would have this sales returns account. And also, if our customers, just like our vendors can give us credit terms and discounts if we pay early, we could, if we wanted to, we can do the same thing with our customers. If we sold the merchandise on account and they pay us within an early discount period, they can take advantage of a sales discount. And that's when we would use the sales discount account. Okay. Transaction. November 3rd, Computer City sold $2,000 of merchandise to Highlander Pub on credit terms 210 and 30. We originally paid $1,200 for the merchandise. We use a perpetual inventory system. Because the perpetual inventory system is used, we need to record two journal entries when we make the sale. The first journal entry is to record the sale, debit the accounts receivable, and credit the sales. We've been through this already, by the way. And we need to record the reduction of the inventory. Debit the cost of goods sold, credit inventory. If it was a periodic, by the way, we'd only have the first journal entry here. There's no keeping track of inventory or cost of goods sold during the year with a periodic system. But perpetual, we record both of them. That was on November 3rd. Now, 2 days later, November 5th, Highlander Pub. Now remember, we sold $2,000 worth of merchandise to them. They're returning 1,000 of it. It's unsatisfactory. Maybe it was the wrong color, wrong size, whatever. All right, and so what we need to do is you need to take back the return as follows. Two journal entries. The first journal entry, as you see down here, is to partially reverse the sale. Now, in the prior slide, we saw that the sale was for $2,000, but that was for two computers. One of the computers is brought back. So we're going to reverse the sale. And instead of debiting the sales account directly, we're going to debit this contra revenue account called sales returns. And we're going to reduce the receivable with a credit. In addition, we're going to take that inventory and put it back on our shelves. So we're going to increase the inventory with a $600 debit, and we're going to reduce or reverse $600 of the cost of goods sold. Remember, in the original journal entry, we debited cost of goods sold when we sold it. Now we're going to reduce it with a credit. Okay. In addition to your customer returning merchandise to you, they can also take advantage of a discount period. And remember, the original journal entry was on November the 3rd. And if they pay within 10 days, they get to take a 2% discount. Say your customer pays you on November 10th. That is 7 days from the sale date. They made their 2% discount period. So what we're going to do is we are going to receive cash. Now remember, they originally owed us $2,000, but $1,000 was returned, so now they only owe us $1,000. The customer is paying within the discount period. So instead of the customer giving us $1,000, they're only going to give us 98% of the $1,000, or $980. That's why we debit the cash for $980. We're going to reduce the accounts receivable for the full $1,000. The difference between the receivable that is written down and the cash that was received, in this case $20, that is another contra revenue account. So in addition to the sales returns contra revenue account, we also have the sales discounts revenue account. Okay, now delivery expenses. Like I said, transportation costs to get the product to us from our vendor to our location, that is part of the inventory cost. But when we have transportation costs to sell it to our customer, that is a delivery expense. It is not part of the cost of goods sold. Be very mindful of that. Big difference. And one of the last items we want to talk about in this particular chapter is accounting for sales taxes. Ultimately, a lot of retailers act as, let's say, free collection agencies for the government. The government is expecting to collect sales tax from all of the sales that the retailer is making. So as an example, if I, as a retailer, sell $1,000 of merchandise, and in my local county, there is a 7% sales tax rate, we are not only collecting $1,000 from the customer, we are also collecting a 7% or $70 worth of sales tax. So we're going to increase the cash account with a debit for $1,070, but only $1,000 of it is sales revenue. The other $70 is a liability. It is a sales tax payable to the government agencies. All right. So, and then of course we're going to fill out a sales tax return, and we will remit that sales tax amount when we fill out the tax return. Typically that's what is done. All right. So we do have to keep in mind that in addition to collecting sales revenue, we also have to collect certain other items like sales tax is a perfect example. All right, and so that is basically what I wanted to talk about here in chapter 6.